Today's market behavior was remarkably instructive. The decline from SPY 672 to 663 offered a precise view into the underlying structure of sentiment, liquidity, and momentum as we transition into the latter part of October. And yes, that large red weekly candle is absolutely the elephant in the room. It represents a critical inflection point in both market psychology and structure. Let's unpack what it truly implies, because that bar now defines the battlefield for the weeks ahead. That candle embodies a rejection from all-time highs, accompanied by wide-range volatility and strong volume. It tells us that buyers exhausted themselves attempting to break through resistance near 685, while sellers stepped in with conviction. The size of the body, the upper shadow, and the close near the lower end of the range all confirm that distribution occurred at the top, not mere profit-taking, but active rejection of higher valuations. Now, the implications are symmetrical but profound, depending on which side breaks first. If price breaks above the high of that red candle, 672 to 673, and sustains it on a weekly closing basis, that would represent absorption of supply, meaning that all of the selling embedded in that bar has been fully digested by buyers. In classical market structure, that kind of breakout is a bullish continuation signal, often followed by a measured move equal to the candle's full range, roughly 20 points, which would project an upside target near 692 to 693. That scenario would indicate that the prior rejection was a false top, and that momentum has reignited. It would also force short covering in the broader index, potentially leading to a short-lived but sharp melt-up. However, given the macro backdrop and breadth deterioration, such a move would likely be an exhaustion rally, rather than the start of a sustained new leg higher. Conversely, if price breaks below the low of that red candle, 663 to 664, with follow-through and volume confirmation, that would validate the rejection and effectively confirm that bar as a pivot high in the current uptrend. In that case, the candle becomes an outside reversal structure on the weekly time frame, carrying bearish implications for several weeks, if not months. The immediate technical target in that scenario lies near 652, where we find the confluence of the 10-week EMA, horizontal support from the August consolidation, and the lower edge of the rising channel. A secondary target, should selling persist, would extend towards 637 to 640, where the 21-week EMA aligns with the trend base. The reaction around those levels was not random. It reflected the exhaustion of buying pressure precisely where confluence was thickest. The 672 zone, which capped price early in the session, aligned with a prior swing high on the charts, an hourly pivot cluster, and the upper boundary of a short-term rising wedge. In other words, this was the technical equivalent of a pressure point. The subsequent fade and follow-through lower confirmed that sellers remain attentive and opportunistic at the upper edge of the recent channel. In short, that candle has become the defining reference point for market structure. Above 672 to 673, short covering breakout, potential blow-off towards 690, but likely unsustainable. Below 663 to 664, confirmation of distribution, initiating a corrective phase, targeting 652 initially and possibly 637 later. Whichever side breaks first will likely dictate direction for the remainder of the fourth quarter. Until then, we're effectively coiled inside a wide volatility band, a tightening apex beneath record highs, carrying both tension and fragility. The retest of 667 to 668, our short-term SPY target that we anticipated, did occur, and the market briefly extended an overshoot to 663, before a modest rebound took hold. Yet the rebound lacked conviction. Momentum indicators, particularly RSI, failed to confirm the bounce, and volume contracted during the recovery. This sequence is emblematic of a market that is attempting to stabilize, but doing so with diminishing internal strength. It suggests that while the bulls are defending, their efforts are reactive rather than proactive. In summary, this week's developing bar is less about immediate collapse and more about balance shifting toward caution. The long-term uptrend remains technically intact, but the short-term momentum signatures, both in oscillators and volume flow, are signaling that the path of least resistance is no longer straight up. From a structural standpoint, SPY is now engaged in what may be described as a corrective phase within a broader uptrend. The price action does not yet constitute a breakdown, but the market is probing the limits of its equilibrium range. The 663 to 665 zone has now become a critical fulcrum. Should that level give way with conviction and volume, it would likely usher in a deeper retracement towards 654 to 652, corresponding to the hourly S1 pivot and the lower boundary of the recent value area. Conversely, a sustained recovery and close above 670 could trigger a reflexive bounce towards 674. If SPY were to reclaim 670 on a decisive close, the next mechanical resistance lies near 674, which corresponds to the upper Bollinger Band, the top of the regression channel, and the supply shelf from the October high. The probability is that such a move would meet immediate supply and fade back inside the range, rather than establish a breakout base.
In essence, a move above 670 would be a reflexive recovery to retest exhaustion, not a confirmation of trend resumption. In the current context, with breadth weakening, RSI diverging, and momentum oscillators rolling over, that type of rally would likely serve as the final lower high test before the market resolves the larger ascending channel to the downside. When you look across the internals, several things stand out. The RSI has been hovering near the upper bound of the neutral zone, but not breaking into true overbought territory. A subtle divergence from prior thrusts earlier in the trend. That flattening of RSI, while price continues to press marginally higher, is a textbook early warning of momentum fatigue. Meanwhile, the weekly stochastic oscillator is curling downward from elevated levels, suggesting that even if price closes only modestly lower, the oscillator will likely issue a sell crossover by next week's open. Historically, those crossovers from such heights have preceded multi-week consolidations or retracements within the broader trend. The broader daily and weekly charts reinforce this interpretation. Price remains confined beneath short-term declining moving averages, while the weekly RSI and KST indicators have flattened, a pattern that frequently precedes range expansion. Given the ongoing contraction in implied volatility before this week's earnings cycle, the natural course of the next phase is an expansion in realized volatility. Historically, when the market transitions from compressed volatility under weakening breadth, the expansion tends to favor downside resolution first. In summary, what we're observing is not yet a breakdown in the classical sense, but rather a transition phase, an inflection between distribution and potential trend reversal. The next 24 to 48 hours will likely see implied volatility stabilize, after which directional conviction should return. Until that point, mean reversion scalps remain the more prudent approach, with any failed retest of the 15-minute VWAP on Friday morning likely inviting renewed pressure toward the 662 region. Should that level fracture under thin liquidity, a Monday continuation into the mid-600s and 50s would fit neatly within the technical rhythm that has defined this pullback. I think that's about it. And if you found value in today's analysis, and if you think we earned it, please give a thumbs up and subscribe. Until we meet again.